Well, thank you very much indeed. And Heather at the Institute, thanks very much indeed for doing the necessary around the technology there. Welcome to all of you who are joining us from wherever you may be in the world. Welcome to the Chartered Banker Institute Forum, where we will discuss the impact on banking from various pandemic funding sources, specifically in the UK, looking at bounce back loans and wider afield. And we also welcome those of you watching from around the world, especially our Institute members near and far. It really is great to have you with us, whether it's in live time here or whether it's in some form of catch up later in time. I'm Bill McCall. I'm the current president of the Chartered Banker Institute, which is the oldest banking institute in the world. And not that I or any of the executive group who lead the institute have been around for that entire duration of the institute at all. I'm about the 60th or so president in its near 150-year history. So also to remind those of you joining as members of professional bodies, this can also be recorded for CPD purposes too. So the added bonus of a wonderful panel, an excellent discussion, and you'll be able to clock up 1 hour of your many hours of required CPD at the same time. Now, joining me is a panel of experts, carefully drawn to cover as much of the topic as we can in the next hour or so. And I'll make some brief introductions in a moment, and the full backgrounds of our panelists, which I couldn't even scratch the surface of, can be found elsewhere on the Institute website. But I would also invite you in real time, not if you're watching on catch up, to submit your questions through the usual channel on Zoom, and I will endeavour to play those into the panel during the course of the discussion. And a quick reminder, if you are watching later, don't be surprised if we don't answer those particular questions. Now, some context. Sadly, and very sadly, some 2 million souls have lost their lives in this global pandemic. The human cost is painfully high. And in the UK, the economy is facing a double dip recession for the first time in 45 years. And the impact of the pandemic causing further damage on health, well-being, employment, and the outcomes of those are still being considered. The financial emergency packages that were brought to bear quickly by the government in the UK and in other parts of the world have brought some respite. Some, however, have been criticised, some were poorly executed, and no doubt a lengthy inquiry post-pandemic will follow. But I want to pose this question for our audience today as we consider the financing solutions that UK banking has provided via government. If your house was on fire, would you call the fire brigade or call an architect? And of course, it's a trick question because it's a matter of timing. You need both. So what we're talking about is the emergency support schemes that were brought to bear in the very early days when the crisis was perhaps misunderstood, not understood, or developing in front of policymakers as they tried to make policy to deal with something that, frankly, the world had never seen before. So to consider our topic today, in the UK, we have Chris Leslie, the Chief Executive of Credit Services Association, that he joined in the summer of last year, mid-pandemic and everything else. Chris, you may recognise, is a former Shadow Chancellor in Westminster and was a Member of Parliament, not once, Chris, but twice. Always an interesting comment to be made there, no doubt. He was also Shadow City Minister and is a former policymaker through those roles. Clearly, he has a deep understanding of the financial sector and knows it extremely well. So, Chris, you're most welcome to join us today.
Thank you.
And if you've ever read the Lex column in the Financial Times and wondered how the Financial Times journalists learn to do what they do, look no further than Jane Fuller, another panelist for us today. Now, Jane is a former financial editor, an assistant editor, and a Lex writer at the Financial Times, spending almost 2 decades there. And she continues to this day to train Financial Times journalists. She is an honorary fellow of our Chartered Alliance partner at the CSI and a fellow of the CFA Society. She's currently a director of Centre for Study of Financial Innovation, and you may well have watched the excellent output from that entity online through the course of the pandemic. Jane is also a visiting professor at City University London. Also joining us, I think probably from the Southwest today, is Stephen Pegg, a recovering banker, Stephen, and one of us for those of the bankers watching today. Previously at Lloyds Banking Group in several senior roles there, he is Managing Director, Commercial Finance at UK Finance, and a leader in all manner of things of interest, not least the UK Business Angel Association and a trustee of Prime, an initiative founded by His Royal Highness, the Prince of Wales. And in a different time zone and our deep appreciation as it's around 11 towards midnight in the evening, in Australia is Joseph Healey. Joseph is a fellow of our Chartered Banker Institute and one of the many Scottish bankers who escaped to different lands to bring influence to bear there. Now, he's currently co-founder and CEO of Judo Bank in Australia, which operates in Australia and New Zealand. And it's one of the main challengers in that part of the world. Prior to that, he had senior roles in a number of banking houses, too many to mention. He's also an academic, a writer too, and his most recent book looked at what went wrong with the Australian banks and the impact of the Royal Commission there post the wake of the great financial crisis. So Joseph, you are very welcome here today as well. Now, when I look at the CVs and the careers of the 4 individuals, I'm somewhat in awe, and we could probably fill many hours of debate. However, the key thing for us is to get on to what we're going to do today. So before diving in, I'd like to thank all of them, because we may run out of time at the end, and thank them all genuinely from the Institute for giving of their time and views. In turn, each will give a brief position statement to kick us off. And we'll start, Stephen, if I may, with you. I use the term recovering banker generally. From your standpoint now, how do you see things?
Thanks very much, Bill. I'm delighted to be here today. Clearly, we are still very much in the midst of this crisis, in the UK certainly, and I know many other countries it's the same. And in fact, these lending schemes that have been put in place to support businesses are still open for business. Bounce back loans was one of the government lending schemes aimed at the very smallest end of the market. The maximum loan is 25% of turnover, or £50,000, whichever is the larger, or whichever is the smaller, I should say. So you can't borrow more than that 50,000. And it's been the volume end where the initial loan scheme that was put in place was not really well suited to the kind of processes that are common, provide very small loans, the regulation that applies, and the volumes that were expected. It came in the beginning of May last year, and so far over £44 billion has been lent through that, so an awful lot of money to 1.4 million customers. It is self-certified, which makes it very unusual, 100% guaranteed by the government, and it's a fixed interest rate of 2.5% with interest covered by the government for the first period. 28 accredited lenders have been lending, and there is an estimate And as you can imagine, for bankers on the line, probably it goes against every grain of your training that customers themselves should decide whether it's affordable without any intervention, that there will be an expected fairly high default rate. The Department of Business and Government have estimated it will be at least 35%. That's 500,000 customers. And because the peak of lending was around May and June last year, the first payments being due May and June this year, the expectation is that the peak of default, if you like, where they've gone over 90 days, is going to be around August, September. So you could just imagine that that's quite a big challenge in terms of volume, customer treatment, reputation. What we've been doing as an industry with many of our members through a task force is talking to the government, making sure we're totally clear as to what the expectations are. And we will be working hard, I think, as an industry to make sure we balance the requirement to get recoveries back for the taxpayer where possible, meet all the requirements of the schemes and compliance and guidance that has been carefully negotiated, but also treat customers sympathetically and fairly. For many businesses, this has been a unique and unexpected situation, albeit, let's put it in context, that there's over £200 billion worth of SME lending that exists out there. Half of those businesses don't borrow at all. Many businesses, including those who borrowed these facilities, free money as it were, have just put it on deposit and so may well just repay immediately. But nevertheless, we have a big job to do in terms of how we'll work through that group. And very much that's going to involve Chris's members because, as is business as usual, debt collection agents have a key role to play. And we've been working with many of them to kind of look at how that can be done, potentially on a collective and standardized basis. So Bill, I'll leave it there. Appreciate time is short and we've got many questions to come on to.
Thank you, Stephen. That gives us an interesting platform from the practitioner and the profession side of the equation. Chris, I'm sure you're pleased to be out of politics. And, I can imagine that's, or maybe you're not, because it seems somewhat busy at the moment. Don't answer. What is your take on things right now from your own experience and your members' experience, and also what you've heard from Stephen?
Thanks, Bill. And I think Stephen's given a really good sort of bird's eye view of the UK bounce back loan scheme. And I think, from my time in politics, you compare crises over the generations, and certainly global banking crisis back in 2008, 9, 10. I think the statistic is, in terms of welfare and other support for the wider populace, something like 1.5% of GDP. In this particular crisis, it's gone up to 26% of GDP. The amount of the combined impact, so not just business support, but furlough scheme for employees at 80% level in the UK, self-employment, income support, as well as extra public expenditure, something like £400 billion, about the size of the Irish or the Norwegian economy, dropped into the UK. And that is the level of government intervention that we've seen. Now, from a political point of view, I mean, this is obviously a crisis period, but at some point those consequences and dealing with all that will kick in. And from my very small trade association point of view, representing UK debt collection, debt purchase sector, we're obviously starting to think about the ramifications of that process, and particularly from the point of view of the taxpayer. So in the bounce back loan scheme, as Stephen was saying, something like 45 billion of lending that's gone out on a fairly light touch basis, as Stephen was saying. And from our point of view, and from the taxpayer's point of view, there is this difficult balance. It wasn't given out as grant, it was given out as loan, but you have to be sensitive to the very difficult circumstances these SME sector are experiencing. I think it's something like 60% of those SMEs are sole traders and in many ways self-employed. And we all know that there is historically a bit of a blurred line between business income and personal, there's that commingling of personal finance. And a lot of people have been speculating, well, you know, what is happening to this? And Stephen's right, a lot of it has gone on deposit. People have taken that opportunity, but a lot of it, you know, there has been a lot of anxiety in National Audit Office in terms of fraud expectations, in terms of other uses. It's a very, very difficult challenge. And from my point of view, I'm sort of thinking, well, at some point, I think the taxpayer interest is going to be asking, well, how much of this can be recovered and how much of this will be repaid? And we make a simple argument, which is you can either sort of turn a blind eye to this, almost Treasury, and I hope they don't imply that this is just sort of a write it off as lost, or actually better, in my view, to engage with those SME customers, to have a dialogue, to start at this particular point now. It will take a particular set of skills to do that, and a lot of the core banks don't necessarily have that in-house. A lot of that is outsourced traditionally for collections, but in particular now I think it's going to be incredibly important. We've just published a report a couple of weeks ago on some of the aspects we think need to be attended to. You won't be surprised that it's emphasizing this engagement and having a real focus on that. To what extent, if the banks are offered 100% guarantee by the taxpayer, and that is then triggered, you know, 12 months after the collection period commences, to what extent is there really a motivation for the banks as the creditors to absolutely do that engagement above and beyond business as usual? My worry is that it isn't really there as a commercial incentive. And somehow that needs to be thought through, particularly from the taxpayer perspective. So, Bill, I think that is why we've made various recommendations about warranty, fraud, and so forth. And I'll post on the chat the link to our report so people can read further.
Yeah, thank you very much indeed. And the report is a good read from that perspective and gives a real insight into the challenges. And also, I have to commend the fact you made recommendations, which many reports don't, which is a staggering thing. Turning to you, Jane, thanks very much indeed for joining us. With your journalistic experience looking across the piece, what do you see as the developing themes of interest for us, given what you've heard and also what you've been involved in over the course of the last 10 months or so? We've got you on mute for the moment, so if you wouldn't mind, that would be great.
Sorry about that. Sorry. Yeah, so it's an interesting moment because we've obviously got a budget coming up in March, and the first key thing will be to try to avoid the cliff edge. So whether we're going to have an extension of the furlough scheme, extension of rates holidays, if that happens, then I suppose the government will need to subsidise local authorities, you know, more directly if they're not able to get in the rates that they need. Big question over whether there can continue to be sort of forbearance on rent and what the knock-on effects might be on the property sector. And I suppose if you also think about furloughs or even a job retention bonus, I mean, there is an interesting but important point, which is to what extent do you want to preserve jobs in aspect in sectors that even when they come back will be smaller, and to what extent do you want to encourage people to move into growing sectors or the growing businesses within their sectors? So I think that there is an interesting interplay between things like a job retention bonus and actually whether benefits are kept at a level where it's actually easier for people to, you know, give up one job, survive and start another one. So I think that's an interesting political area. In terms of the cliff edge, one idea is to revise the enterprise finance guarantee scheme, and that Mark II would be a lot less clunky. It would still have an 80% guarantee. It would allow however, it would allow the reintroduction of lending rates at a more realistic level than the 2.5% that's been prevailing in the emergency. So that's one side of things. The other side is, of course, how banks manage it. And there's the you know, there have been scandals over the way banks have in the past used the vulnerability of debt-laden customers to actually asset strip, and the worst example was HBOS Reading. So I think that, but I think hopefully quite a lot of lessons have been learned. Actually, as they were in the mortgage sector, so there was rather different treatment in the last housing crunch to the one that prevailed 30 years ago. Because actually, if you just foreclose and chuck people out, and you end up, what are you going to seize as assets at the very bottom of the cycle? So there is, you know, actually being a little bit more sophisticated about it and helping businesses that have a chance of being viable through this means that you in the long run you'll do better in terms of the assets and the cash flows that you're supporting. So I think one of the interesting things is that there will be that probably have to be a bit more human intervention, and it's interesting what Chris has to say on this in terms of both the underwriting, so you know, the original lending decisions and making sure that customers understand it in the context, as has already been said, of many of these being borrowing debutantes. And the other thing is then how you manage them subsequently. And so I think that you know, on the one hand, you've had to have a great sort of automated effort to get cash out through the bubbles and the subbles and so on. But actually going forward, there's going to have to be a bit more hand-holding, human intervention. But that can go alongside some other developments in terms of the lenders having access to real-time information about the companies, which could be facilitated either by accounting software or open banking and so on, so that they, when the humans have to make the decisions, they're actually better informed, thanks to progress in automation and IT. So those are a few of the things that I think banks will have to think about.
Thank you, Jane. It's good to know that humans will make decisions and we won't all be moved away by the AI robotic position. All of that very detailed coverage of the UK position. And I was very keen that we had a more international outlook too, for those of our members who are not sitting in the UK. Joseph, in your geography, you have a very similar but different dynamic. You're closer to China as a major trading partner, and it's a significant part of the Australasian economy. You had a moderately different response from government to this pandemic, both in lockdowns and the way things were treated, etc., etc. So as someone sitting in that jurisdiction looking at us, tell us about your experience first of all, and then perhaps reflect back on your view of what we've been doing over here.
Yeah, thank you, Bill. I mean, I should say at the outset that whilst based in Sydney, Australia, I mean, I'm a keen observer of what's been happening, not just in the United Kingdom, but in normal times I would be in the United Kingdom at least three times a year, and so I'm very much reasonably up to date with what has happened in the UK. Now, one of the things about the Australian landscape in terms of regulation and the way that the banks operate is it's very similar in many ways in design to the UK. The regulator here, main banking regulator, looks to the PRA, and there's quite a lot of what I'd call fast following that takes place. And I think from a government point of view, and I know from talking to the Treasury back at the end of March, that they were looking to the UK and other markets, but the UK in particular, to get some insights into how the UK government was thinking about the emerging crisis. What we did in Australia back at the end of March was the government did very quickly announce a number of schemes, but one of them was a government guarantee scheme administered through the banks, where the banks took 50% of the risk. So this was not 100%, it was a 50-50 risk exposure. The government allocated 45 billion Australian dollars, which crudely is about 22 billion pounds. I'm doing the Aussie dollar exchange rate a disservice, but if you roughly just cut it in half, it keeps the math easy. So $45 billion, maximum loan was $250,000, £125,000 over 3 years, had to be used for working capital, couldn't be used for any other purpose. And to cut a long story short, after about 4 months of that scheme being in place, its utilization was very low. So the 45 billion, less than 4 billion had been allocated into the SME economy. So then in June, the government restructured the scheme and increased the $250,000 to $1 million, so £500,000, extended the 3 years to 5 years, allowed the use of funds to go beyond working capital, so it could be used for a whole range of investment as well as working capital, allowed the banks to take security. The early scheme was unsecured lending, so allowed the banks to take security, but not real estate or residential homes as security. So the banks had to look for some other form of security, and capped the interest rate at 10%. But also insisted that the 50-50 split of risk stayed in place. And I think that is quite an important development because it deals with the potential of moral hazard, where the banks are just pushing the money out the door with no regard or no responsibility for its suitability, its application, and the prudential nature of lending. And so we've stuck very firmly to this 50-50 risk exposure. And the way that that's being administered within the banking system, including the bank that I run, is that certainly from the bank that I run, we look at each loan as if the bank was taking 100% risk exposure. So there is human judgment being exercised in the allocation of funds. And so we say, like, let's forget the government guarantee. Would we lend this company 100%? And then we work back from there. Now, that also, from a bank, I think from a prudential management point of view, that has a lot of merit to making sure that money is being sensibly allocated and not simply spread across the economy, much of which would be poorly used and could result in significant financial distress. The downside of that approach, however, is a pretty lukewarm enthusiasm from the banks to engage in this whole exercise. They've kind of course, like banks in the UK, they've been somewhat overwhelmed by customer distress. And over many years, through an industrialization of the way the banks have operated, a lot of the core skills around working with distressed customers have been lost in the industry. And suddenly there's a huge demand for these skills. So the banks really have not been set up to cope and to administer the government scheme. So whilst the new scheme has been in place for a few months now, or 5 or 6 months, the uptake is still underwhelming. And the banks argue that it's a lot of work, even though it's 50% government guaranteed, it's still a lot of work. They've got to demonstrate responsible lending, because in Australia we have responsible lending laws, relate primarily to consumer, but to Chris's point, I think, that the household and the business balance sheet is quite often bundled when it comes to SME. So you've got to demonstrate that you've been absolutely thorough in your due diligence. And that's resulted in a rather lukewarm enthusiasm for embracing this particular scheme. Now, having said that, the government continues to listen to the industry, continues to signal its willingness to fine-tune and develop. There is a big concern about, I think, is a point that Jane made about this cliff. You know, whilst Australia's COVID-19 experience has been nothing like it has been in the UK, there still was a period up till around Christmas time when, particularly in Victoria, when the economy was basically shut down for 100 days. And there was this concern that there was an accumulation of unproductive liabilities, not just deferral of bank loans, but rental payments, tax payments, a whole range of other creditor obligations were kind of being pushed out, but not going away. And then when the law and the insolvency laws were relaxed, I should add that the other thing that the Australian government did was it relaxed the insolvency laws temporarily, and it allowed businesses to operate in technical insolvency, so long as they were doing so in good faith. And that allowed a lot of businesses to continue to function, albeit some in zombie form. But we've had a 40% decline in insolvencies over the last 12 months compared to the average of the last 10 years, which clearly disguises a significant build-up. So that's the kind of landscape snapshot of the Australian environment and its comparisons.
Joseph, thank you. What you talk about there, and particularly that last point, the UK has also witnessed a drop in insolvencies within the SME space, quite a considerable drop in 2020. In coming back to the UK, Stephen, there is a question from one of our viewers, but also it plays into something else I wonder if you might touch on. I don't think there is an existential risk to the UK banks dealing with write-offs as there was in the great financial crisis of a decade ago. But did we learn sufficiently from that? And has that set the banks up in a better place than they were at that point?
Yes, absolutely, very relevant actually to this. Since the financial crisis, a code of a good practice for business support was developed by the Institute for Turnaround, and much of that has been incorporated into the standards of lending practice, which the Lending Standards Board administer for small and medium-sized enterprises. The coverage of that was extended to businesses up to a turnover of £25 million, and very much the kind of good practice in the industry has been, used to inform the kind of guidelines and expectations around these schemes. So I think it's an important point. Whilst some of the examples of difficulty really were down to criminal activity, in some narrow cases, and perhaps that wasn't common across the whole sector. Nevertheless, continued learning lessons and professionalism in supporting businesses that have the potential to actually turn around is tremendously important. And I just wanted to reinforce that point. I think, even where those businesses are with bounce back loans are currently in arrears and unable to make their repayments, the Chancellor did announce pay-as-you-grow options, which could be will be available to all customers to use, whether or not in financial distress. But for those who are still under real pressure, buying time in combination with the equivalent to Joseph's Australian moratorium will help many businesses just weather through, the early part of this year, hopefully to a point where actually they're able to succeed again. All of the collections arrangements need to consider whether actually just a little bit more breathing space, a bit of debt advice, some restructuring could actually help that business kind of stay in business. But nevertheless, I think we do expect for many businesses that not to be enough, and to that reach the point of formal demand, and that's the point at which you click into a need to help and support recoveries. There, I think it really is still a balance of, making sure you're treating customers well, being realistic about repayment plans, thinking about, what is affordable, so that there is some, return. I think that inevitably, though, will weigh on their credit, status for the future. And I think, the other concern we've all got is, even for those businesses that stay in business, how do we make sure that they got the ability to, not be too overburdened in debt that they can't actually invest for growth in the future? So that whole element of recapitalisation has also been an important factor.
So playing across to the catching side of the equation, Chris, when some of these loans trickle down to be collected professionally, and the government, or the Treasury, has signalled one way or t'other, and you were very clear earlier that if they just signalled that these were in essence grants and free money, the game, everyone up stumps and that game's over anyway, and it's public purse stuff. socialising the losses, and off we go again. But assuming there is a sensible view that arrives at the fact that these loans were taken in good faith, a point that Joseph made also in Australia, and some companies were in liquidity crises rather than solvency crisis, and they managed to get themselves through. Do you have to look at the way and the conduct of your membership and just simply the way they do things? I know that's very much in your reckoning, because this circumstance isn't one that anyone was thinking about just 12 months ago.
Yeah, I mean, I think it's there are lots of different aspects here. I mean, Stephen's right. The scheme in the UK has already baked in a certain approach to forbearance. I think it started with the option of a 6-year repayment period that's been extended to a potential 10-year period. There are already options within there about interest and payment holidays, 6 months and so forth, if you know, repayments can't be made in a particular way. But you know, I think the psychological animal spirits issues are really important in the design of all this, because I mean, you know, we're talking 1.5 million businesses here. If they get that sense that there is a sort of write-off in prospect, or you know, then you know, the ability, payments will just simply cease. And I think it's really important. It's obvious thing to say, but government, British Business Bank, and the creditors of the banks as well need to make it clear this is due for repayment, and that's a consistent message that is continued right from the outset. And also to be fair on those who will repay it. I mean, there's nothing worse than, you know, those small businesses who do make the effort, turn around, get to a position that they can repay, looking at others later down the line who think, well, if only we'd have just deferred. So I think that consistency is really important from the outset. The moral hazard point I think Joseph was raising is also quite an interesting one here. I mean, we're sort of in moral hazard 2.0, you know, from the original banking crisis, and we know all of that particular story. But that is quite interesting here. And lots of different jurisdictions will have wrestled with this question. How do you get the money out quickly and kind of give the banks that incentive to deliver it, because governments just don't have that delivery vehicle out in the real world. And at first, I think the UK Treasury said to the banking community, well, how about an 80% underwrite? Does that give you enough? It didn't quite. So they folded essentially and went to a full 100%. The problem is that balance struck sufficiently to protect the taxpayer interest adequately? And I do think it will be an interesting policy discussion going forward for the longer term, particularly after the guarantees have been triggered. Well, to what extent can the banking community really have either that hard incentive or that moral imperative to collect on behalf of the taxpayer? It is a really difficult thing, and you can see why government, treasury, banking community, this is a really hot potato to handle, and so it's going to take a lot of sensitive moving around. But the collections community, absolutely, the skills that they will need to show sensitivity, to show understanding. Public sector in the UK, being frank about it, doesn't always have the best reputation when dealing with debt management on a sensitive basis. You know, if you're a local authority, often in the UK, you miss your council tax payment for 1 or 2 of your direct debit months, and bam, it's can be straight into an enforcement process. And you know, the public sector it recognises itself. The Cabinet Office has made it plain. They've got a long way to go, almost to learn from some of the forbearance approaches and the sensitivity that, ironically, the private sector has been pretty good at, because it can often stretch forbearance over a number of years, where public sector feels, you know, HMRC has to collect its taxes within a 12-month period and so forth. So we're really trying to impress upon public policy makers to learn from private sector techniques of forbearance and dialogue with customers.
So you're not saying, and I don't think any of the panelists would agree, that the amount of money that's hanging out there in this B-bill potentially doubtful bucket is so insignificant it should just be forgotten in the face of, you know, 30 billion of VAT that hasn't been collected, and 400 billion here and 100 billion there, and 7% unemployment, everything else. You might as well just round the numbers up to the nearest whatever and crack on. And I'm sure, Jane, from a writer's perspective, tell us what you think the Financial Times will be writing in a few months' time about the aftermath of this. Where do you think, if you unpick, as you've always done, the bits and pieces, because within the government ecosystem, I'm sure Treasury would love to have it all back. There will be some politicians feeling a bit uneasy because they know where constituents are and all of those conflicts of interest around. What do you think, Jane, that the future is going to be writing about? Where does your journalistic angle take you?
Well, I think it's a bit like COVID, that we just keep hearing all the bad news. And actually there was a big story in the FT this week about, finding small business people who are suffering the most and, running out of cash, very nervous about the cliff edge as the end of March approaches. So there's going to be, those, instead of focusing on the probably majority who have either survived or have been able to close their businesses and are lying low and will restart, there's all sorts of permutations. There will be a focus on the ones who are going to go, being driven out of business because they've been closed down, so obviously in hospitality. So that's where the headlines are going to be in every type of paper over the next few months. The greater perspective, then also in terms of taxpayers' money, you're right that 10 billion here, 10 billion there. But I think that there's also because the issue that some of these loans have been acquired by fraudsters, there is an angle, which is, hang on, there needs to be some discipline here. And there is, possible naming and shaming where, it's found that the borrowers were not, what they purported to be. I think there's also, in terms of the bank's reputation, we'll have to be very careful. That's been covered really, the need to be sensitive about it. But having said that, I think that the 100% guarantee, has made a bit of a rod for the government's back, and that there should be some skin in the game, whether it's 50%, as Joseph talked about, or whether it's 80% leaving the banks at least with 20 on the hook for 20%, which is probably what the government wanted to do in the first place. I think they do need to row back from 100% guarantees ASAP, because there will also be stories about the burden on the taxpayer. There's another idea being floated, which is that these loans could be treated like student loans, that that they'll be sort of deferred and paid back eventually when the businesses reach a certain level of profitability. I'm not a great fan of that, and I think we've just heard quite a good argument about the problems of just you defer and defer, and what's the student loan default rate, 50% or whatever it is. If it's going to be a 50% default rate, maybe it's better to bite the bullet now. The other thing you have to bear in mind about journalists is that we don't have to be consistent. So somebody can be writing about poor mom and pop business one day, and oh my God, burden on the taxpayer the next day.
It's very similar to politics, really, isn't it?
Yeah, how very refreshing of you to remind us of that point. Sadly, the bankers, Joe, have to deal with the loan book from a sort of single point of view. From where you are, and as a newish bank in Australasia, do you see this as an opportunity for you to be a prudent, good steward of money and a highly professional entity at this point in time? Is that the real benefit?
Well, I think you've made an excellent point, Bill. I mean, one of the motivations for establishing Judo Bank, well, first of all, we saw a fundamental market failure in the way the banking system was engaging with the SME economy. But secondly, a complete collapse of professionalism in the industry. This was true in the UK too, that stretches back a decade, if not longer. And we wanted to build an organization that as a foundation that had professional values, traditional banking values, great consciousness of the social license, if you will, that the community and society gives the banks, such a privileged, hugely privileged industry. And therefore, to make sure that we accepted that social responsibility, that we redefined what professional standards meant, and that you treated money and allocation of credit across the economy between the household and the business sector, and you did it prudently. Because there's nothing worse than being reckless in the way that you lend money. I mean, the damage that you inflict on families, on small businesses, might turn up in the bad debt line, in the provision line on a bank, but the harm that is done to individuals and sometimes to communities is something that I find quite unacceptable. So whilst it would have been convenient for the government to say, we will take 80% or 100% of the risk, I feel that the 50-50 allocation imposes a discipline on the banks to conduct themselves in a professional manner and make sure that the allocation of capital is being done in a thoughtful way, not in some kind of helicopter drop fashion, because that will leave untold damage in the future. And it's not, and it will damage the reputation of the banks, because when the dust settles and the post-mortem is held, people will look to the banks as bad actors in the way that they conducted. They will point to the government and say, well, we were forced to do this. But that's not acceptable. You know, again, you have a responsibility to conduct your affairs in a manner that is professional, and it's in line with community and society's expectations of what a bank should do. So we've been very firm on that all the way along. And that's why when I said earlier on, the credit policy within the bank when it comes to SMEs with government, 50% government guarantee, is that we will approve the credit on the assumption that we are accepting all the risk.
Yep.
And the 50% guarantee is something that we can have in the event of a financial distress, but we should not be lending money to businesses that we feel that we're only going to force them into financial distress and create the so-called zombie firms that are going to plague so many industries. And Jane touched on this earlier, because of the rather casual and free manner in which credit has been extended. I think the industry is setting itself up for a huge reputational hit by participating in the way that, as I understand it, that it is in supporting the government policy here.
So I guess.
Do you mind, Bill, if I just sort of follow up briefly on that?
Stephen, because, please do. I would come to you. Please go ahead.
So I mean, the other main loan schemes do have banks with skin in the game and do have a credit assessment process. So coronavirus business interruption loan scheme and the larger version, CL bills. And in fact, we've been advocating that actually bounce back loans would not be the future, should not be the future design of follow-on and successor schemes. But I think if we look back to where we were in April, May in a full lockdown, and almost complete stop to the economy, the government had a clear emergency need to inject liquidity, so there wasn't a collapse really of the economy. And they did not have, as Chris said, the capacity and the distribution means to get that out. They could have just provided bigger grants, but they took the view that where it is possible for businesses to repay, they should be encouraged and required to do so. And a degree of responsibility was emphasized on the business to kind of say, I attest that I'm going to be able to repay that. Of course, people can be very optimistic, and some people might misrepresent their kind of capacity. And indeed, that will have been part of it. But I do think it's probably the right thing to do at the time, and we will look back and say, could it have been done differently with the benefit of hindsight? But I think our expectation was the period of disruption and interruption was going to be shorter than it's actually turned out to be. And I think that's probably exacerbated the levels of default we're likely to live through now. But I mean, I'm a qualified banker, and yes, it kind of goes against every grain of my lending banker being, but I understand, why the government took the view that they did. And I think it's interesting with the 2.5% interest rate, This is not cost-free for the banks who have to administer very small loans and kind of manage all of this and fund it, etc. And many lenders decided not to participate because they couldn't do so. But certainly the larger banks felt it was a social duty to get behind the government's kind of aim to inject this support in the way that they did. I think we've now got to just kind of deal with the consequences, as you say.
Thank you for that. We will see, and those tuning in today in our membership are all operating in the banks themselves. Many are, some are slightly outside banking, as we may describe it generally. I know from speaking with bank leaders and various people in the sector and members of our institute that they've been working under incredibly difficult circumstances at home. How banks actually processed the sheer volume of applications for the C bills, for instance, which are more complex, as you've said, Stephen. The B bills was a slightly different animal completely, but how they managed to do all of that with the entire workforce pretty much at home, dealing over virtual private networks and all of the various things. I think if nothing else, we've learned that the banking profession can operate on a dispersed basis. And the need for everyone to be under the same roof these days is long gone. Joseph, you touched on a very interesting point around the professionalism point. If I then flip across to you, Chris, assuming that there is this trouble coming down the track, and let's just set aside those who were out and out fraudulently applying for money with bad faith and no intent to pay, and those horror stories are beginning to come out. And as a sidebar, we'll share with viewers, and you've all seen the preliminary report from the US Treasury, which just simply dwarfs the numbers we are talking about in an industrial-sized fraud going on in the US. Chris, where do you see, the question I asked Jane, where do you see us in a few months' time? Do you imagine that your members are girding their loins waiting for the hot potato to come to them?
Well, yes, and it's not just, of course, these government underwritten schemes. I mean, the wider question about what is happening with bank lending impairments and non-performing loans generally, and at what point the shoe is going to drop on that. I mean, there's been, you know, if you recall, certainly in the UK context, back in the early summer, enormous impairments posted and reported for various regulatory reasons, also quite upfront. More recently, you know, some unwinding of that. Some people have commented rather cynically that might be related to dividend restart and all the rest of it. But you know, a lot of there's a lot of guesstimating going on really about the level of impaired potential lending that is out there, and certainly for our sector, debt collection agencies and debt purchase, there is a great time lag on when a lot of this work comes through. So for us, it's a waiting game to see what's going to happen. I mean, I think this whole period is a story of that level of government intervention. I mean, you know, Rishi Sunak, the UK Chancellor from the British Conservative Party, has almost been more social democratic, socialistic almost, certainly Keynesian, than any previous Chancellor sort of in the post-war era. The level of intervention has been very, very significant indeed. And a lot of people have been sort of almost slightly surprised by why there hasn't been a sort of enormous sort of change in unemployment immediately at this stage. Why has the British housing market continued to expand and assets increase? And of course, you know, monetary policy has definitely played a big part in this as well. There is a lot of support that has been injected, but at some point, this isn't problems avoided; it is problems deferred. And you know, we will see this happening when the tide eventually falls. I mix my metaphors, but you know, I think it was necessary to have this level of support there, but the pieces being picked up will be a big job, and we have to do that with as much sensitivity and professionalism as possible. And the capacity in the banking sector and the wider non-banking financial services sector is really going to be put to the test here, I think.
So as we are drawing to the close of probably the fastest hour of the week for many, I'm going to come to each of you for a sort of upsum of your thoughts. Hope is not a strategy. An old chief executive of mine told me once upon a time. You have to have a strategy, even if you are a cork bobbing on the ocean. You should have a direction of travel in mind. You can't just simply say, what's the point? Joseph, from your perspective, you look slightly northeast from where you are, well, quite a way northeast, and China's bounced back significantly, and the powerhouse of that Far Eastern marketplace is going great guns, and also the mineral sector is going great guns again. Is that an optimistic point for the banking profession in Australia?
Well, ironically not, because the geopolitical situation has actually acted to counter the geographical and natural resource advantage. The relationship between China and Australia has never, at least in the last 50 years, has never been as low as it is today. The Chinese have imposed a whole bunch of tariffs on wines and dairy product. There's big coal shipments sitting sitting in the sea, trying to get into port and not being allowed into port. The Chinese have really taken a very hostile attitude towards Australia, and it's impacting many sectors. And unfortunately, Australia has found itself caught in the crossfire of the tension between the United States and China, and frankly hasn't played it particularly well. You know, given the huge economic dependence that the country has on China, to fall out with your biggest customer with no real plan B is something that the business community is not happy about.
Yes, and watching it from afar, it does seem that there is a disconnect from the political chutzpah and the economic reality to the P&L of what is Australia PTY.
Yeah.
Chris, any final thoughts from you that you would like to raise just before we close the tables? And I should say to our members that if there is demand, this feels like a forum that could reappear in a different guise talking about different things. So, Chris.
I think the big issues. This isn't just a private sector banking issue. This affects public policy. This is going to be a massive issue. And I've seen from a number of the questions posed, what does this, where are we in terms of understanding of government debt, and at what point that unwinds fiscal policy planning. If bounce back loans aren't collected, is my tax going to go up in 5-10 years time by that amount? I mean, there's a lot of consequences downstream. The second point really is engage at all levels, especially with this volume of SME businesses, an engagement approach as opposed to a sort of hands-off business as usual, send off a rather impersonal letter from HM Revenue and Customs. That's not the way to do this. This has got to be done through relationships and understanding those businesses, but that's a mammoth task.
And Stephen, having seen maybe more than a few cycles, I imagine,
yes.
One wonders what's going through your mind of, here we go again. What are your final thoughts for our audience today?
So I mean, this speaks to the purpose, doesn't it, of banking and finance, which is to support, the economy, customers, and society, really. Sometimes that's short-term liquidity, but it's also long-term investment. And if we're going to have recovery and growth, we're going to need that long-term investment, aligned, I think, to the big societal global issues and opportunities, such as sustainability, that we're going to need to get behind. But for businesses to have that platform, they've got to have the structures and the support in place to enable them to do it. So I think this next phase is as much about what we do with those businesses that survive and the new businesses that are created, as it is about those businesses that unfortunately have got to pack their bags. Dealing with those businesses sensitively is important, but we also need to balance that with a medium-term view. We are very in the moment at the moment, and government naturally is kind of thinking about, are the hospitals going to cope next week? And that doesn't encourage, doesn't give them the bandwidth to think of those medium and long-term issues. I think we need to help them do that. and come with kind of thoughts and solutions and make sure we've got a better balance, because there's no doubt there was a distortion that was caused through this short-term liquidity, distortion to the market as well. I think about my invoice finance clients who found actually their demand for their finance just dropped. We need diverse finance. We need all the players to be able to participate in order to support that recovery. And I think that's the other thing that I want to really make sure that we've got for the future.
Thank you. Jane, coming to you, if you take your sharp pencil to your viewpoint right now, if you were editing what we were talking about today, what would be the highlights for our audience in your final thoughts?
Well, the couple of stand back points. One is that banks are now agents, vehicles for public policy. They were bailed out a decade ago in the global financial crisis. They've had far more interference, most relatively recently, not been allowed to pay dividends. Maybe that will restart this year. They've had far more interference from the authorities as a result. And actually, I think they probably need to embrace the fact that they're now vehicles of public policy, and that will help with some of the reputational issues that have been discussed, and also maybe help them with customer service and with longer term benefits to their business. I think the other point is talking about the outlook from where we are now. At the moment, there's still quite a strong case for forbearance. It's not that long ago that there were still people thinking we were going to have a V-shaped recovery. Obviously, the second wave of coronavirus has stopped that, and we now hope we're in a W, but at the moment we're at the bottom of the second V, but there's a lot of people still expecting there to be that quite a sharp rebound. I mean, if you look at the fundraisings by bigger companies like Wizz Air or JD Wetherspoon, that's based on the fact that once people can spend again, they will. But the fact is, we just don't know. We may have a problem with thrift after all this. For as long as you don't know, I think there has to be forbearance, giving the benefit of the doubt, and all the sort of sensitivity, continued government support that we've been talking about.
Thank you. And I know there are questions about the regulator and how they might behave and how banks may change. We haven't even touched on, is there an asset bubble? We haven't touched on the IPOs of SPACs being the big phenomenon on Wall Street last year and all of those specific things. But we are drawing to the close of our hour, and I know we could continue. And I suggested to the panelists when we caught up sometime last week that we may continue the discussion, because I'm sure, as you've said, Jane, when you don't know, the point is to continue with a strategy that seems to catch as much as possible without narrowing your options. So I would like to press a few thank yous before we close for this afternoon in UK time. To everyone who's joined us, thank you. To the panel, you're all, thank you very much indeed. The Institute is incredibly grateful to you for giving your time and your expertise. And Joseph, particularly, I know it's now getting on for midnight your time, but you'll probably be off out to the pub or something, I doubt, but they aren't open here. To Heather Marsh at the Institute and the team for all the technical wizardry and everything else that they do, thank you very much. And finally, to our membership near and far. To all of you, stay well, and until next time, goodbye.
Thank you.
Goodbye, thank you.